Let's take a look at the accounting for one more defined benefit pension plan. Primary Colors Corporation provides the following information about its post-retirement healthcare benefit plan for the year 2020. We've given a current service cost, contribution, actual return on plan assets, benefits paid, the opening balance of plan assets, the opening balance of the defined benefit obligation, and the discount rate. And we're asked, assuming Primary Colors follows IFRS, calculate the post-retirement benefit expense and prepare all required journal entries related to the post-retirement benefit plan that were made by the company in 2020. And then next we're asked to assume that they follow ASPE and do the same. So the best way to control the information in this question and make sure that we get the right balance for each of the accounts and the right journal entries is to use a pension worksheet, regardless of whether we're asked for one or not. Ironically, we're asked for a pension worksheet in part 2, so we're going to do a pension worksheet for part 1. So regardless, so I've set up a pension worksheet here. You can see that I've got debits are not in brackets, credits are in brackets. This is already set up for IFRS. We're told that Primary Colors follows IFRS, which is perfect. We've already got an OCI column. If they were following ASPE, we would want to clear this column, because obviously there's no OCI in ASPE. And these accounts are on the books and records of the company. These accounts are on the books and records of the plan, which is a separate legal entity. The reason that the company needs to know what's going on in the books of the plan is because the company is required to pick up any deficit or surplus in the plan on this account, net defined benefit asset or liability. So on the statement of financial position of the corporation, they need to show whether the plan is properly funded or not, because they've already promised their employees what they'll get under this plan. And regardless of how plan assets are performing, they are responsible for making up any difference. So let's start by entering the opening balances. So we've got the opening balance of plan assets here, 1,597,500. 1,597,500, I think. Is that the right number? 1,597,500, yep. And of course, we want to label this as opening balance, January 1st, 2020. Then we've got the opening balance of the DBO, which is 1,822,500. And this is a liability, so this is going to be an opening balance, a bit negative. So we're not given the opening net defined asset or liability on the books and records of the corporation, but what would that be? And another question is does this plan have a deficit or a surplus as of January 1st, 2020? Well, the plan has a liability of 1,822,500, and they only have assets of, say, 1.6 million. So there's clearly a shortage in the plan, and that's what's going to be recorded as a liability of the corporation. So it's simply the difference between these two accounts here. So the corporation would have a liability on its statement of financial position of 225,000 as at January 1st, 2020. So that gives us all of our opening balances. Next, we want to look for any other transactions that happened either at the beginning or throughout the year. And the reason that this is really important is because eventually, when we go to calculate our expected return on plan assets and our interest costs on the DBO, we want to make sure that we're using the right basis for that calculation. The basis needs to be the weighted average balance of plan assets or the deferred benefit obligation. So we know what the opening balance is here. But if there was anything that happened at the beginning of the year or throughout the year, we would need to include that in the base that we would use to multiply by the discount rate to calculate out those amounts. So that's why we always want to scan the question to see if we're told that anything happened throughout the year or at the beginning of the year. If it doesn't say it happened throughout the year at the beginning of the year, then we assume it happened at the end of the year. Therefore, it's not included in that weighted average basis. So do we see anything that happened throughout or at the beginning of the year? Well, these two are obviously the opening balances. We've got those. I don't see anything else that happened at the beginning of the year. There were no prior periods off, there were no past service cost adjustments. Oftentimes those happen at the beginning of the year. It doesn't say that the contributions happened throughout the year or at the beginning of the year. So it looks like we're clear there. So the next thing we want to record is the current service cost. So let's start with that. So let's go current service cost. So the current service cost is $202,500, and this is going to be an expense. It's going to be debit expense. And it's going to increase our defined benefit obligation, because what this represents is, as the employees have provided service to the corporation over the year, they've worked for the past year, they've also added money to their pensions. So usually you get a certain percentage of your salary per year that you work as part of your pension. So they've worked for a year, so they've increased the value of their pension. That's an expense for the company. And it's also going to increase the amount that the pension plan has to pay out in the future. Contributions to the plan. So employer contributions, let's record next. So the employer contributions were $47,250. This is going to decrease the company's cash, $47,250. And it's also going to increase the plan assets. So if you think about this as the company simply giving money to the pension plan, it's going to decrease the money in the corporation, but it's going to increase the money, which is, I think of this as a bank account composed of cash and investment. So it's increasing the balance in the pension plan. It's decreasing the balance in the company. They're just simply moving cash. So we got that. Then we've got benefits paid. Let's do that one next. 90,000. Benefits paid. Okay, so a common mistake is to show this as a decrease of cash in the corporation. But the way that a pension plan works is that the employer has contribution. So it moves money into the pension plan, and then the pension plan is responsible for paying out any of the benefits. So paying out these benefits, how much is it? 90,000. So this is going to decrease our plan assets by 90,000. Just think of it as we're giving out $90,000 of cash to a variety of retirees. And it's also going to decrease our liability for future payments. We just settled 90,000. That's 90,000 less that we need to settle in the future. And of course, crediting assets decreases it. And because the DBO has a credit balance, debiting it decreases the DBO. Okay, next we're told, let's look at the expected return on plan assets and the interest cost on the DBO. So on plan assets, think about the company or the pension plan has this much money sitting in. Let's just think of it as a cash and investment account. So they're expecting to earn a return on that amount. They're investing it to earn funds back. So the expected return that we're told from the actuaries is 10%. So we're going to simply take this 1,597, 500 times 10%. And that is what this amount's going to be. We've looked for any other transactions that happened at the beginning of the year, but everything seems to have happened at the end of the year. So we're okay to just take these two numbers as the basis for our calculation here. So the expected return on plan assets is actually going to decrease our pension expense. It's an offset to pension expense. So we want this to be a negative because our expenses are a debit. So we want this to be a credit. So it's a negative expense, if you will. It's almost like revenue or an offset going through our expenses. So it can offset the expenses for the company, for the pension, because they can use the return on the investments to settle some of the liabilities. And this is going to increase the value of the plan assets, because if you think about it, we have that much more cash in our account now because we just received an interest payment. Now, in addition to the expected return on plan assets, we also have to take into account the interest expense on the DBO. Why do we have interest expense on the defined benefit obligation? Well, we know the defined benefit obligation represents the future stream of payments that we owe under the plan. It's a liability, but the liability has been present valued. And as the time value of money gets closer and closer, meaning that if we just think about this as one payment, of course, it's payments to a whole bunch of different retirees over time, but let's just say that that defined benefit obligation was going to all have to be paid out in 10 years. Every year we get closer to those 10 years, we need to take into account the fact that the liability is that much closer. Therefore, on a present value basis, it's worth more. It's similar to a bond. When we had a bond on a that we sold at a discount on our balance sheet, we had to increase the value of the bond every period, so it was on our balance sheet at maturity or at face value at maturity. And this is similar to the DBO, taking into account that present value, time value of money. Every period we get closer, the DBO is worth more, so we're going to have an expense related to that. And the DBO uses the same discount rate as the expected return on plan assets. So this calculation is simply going to be the 1,822,500 because we didn't see anything in the DBO that increased it at the beginning or the middle of the year. So we can just use that basis times 10%, and that is what this number is going to be. So this is going to be, and this is an expense. So you can see the expected return on plan assets is a credit to our expense, meaning it's decreasing our expenses. And the interest expense on the DBO is increasing the pension expense of the company. And of course, it's also going to increase the DBO because now we have this is the time value of money component. So this liability needs to increase on the balance sheet of the plan itself. And it's also an expense to the corporation. So the difference between the expected return on plan assets and the interest expense on the DBO is our net interest or finance cost. So if you look, we have a net interest or finance cost of $22,500. So on a net basis, our pension plan expense for the company went up by $22,500. And that's because the DBO is higher than the value of the plan assets. So this plan is underfunded. On the books and records of the plan, you can see that these amounts are recorded in different sections. Okay, so next we're told, so we dealt with this. Oh, actually the discount rate was 9%. So let's just modify our calculations here. Sorry, I used 10% and I should have used 9%. I think I had 10% stuck in my head from a previous question. So let's just change these to 9. We can change our formulas. Oops, that's 19. Okay, so then this is going to be negative this, and this is going to be negative this. Okay, sorry, we fixed that up. We've still got all the right amounts. Okay, now let's look at the actual return on plan assets. So our discount rate was 9%. And then we're told that our actual return on plan assets, we're given a dollar value here, was $141,750. Actual return on plan assets. So we thought we were going to have a return of 143,775, but we actually had 141. What is it? 141,750. 141,750. So the difference between those two numbers, so what I did was I took in my calculation here, you can see I took 143,775. That was what we expected our return to be at 9%. We thought we were going to earn 143,775 on plan assets for the year, but the question says we only earned 141,750. So the difference between what we thought we would earn and what we actually earned is $2,025, and it's a shortage because we thought we were going to earn 143 and we earned 141. So what that means is that we've decreased our pension expense by too much. We need to true this up for the actual, and this is we're using IFRS here. So we've got our OCI column. So this is a remeasurement loss. So let's put here remeasurement loss on plan assets. And so that is that difference between our expected and our actual return is a remeasurement loss. And under IFRS, remeasurement losses, because it's a difference between the expected return we were provided by the actuaries and the actual return that happened, we're remeasuring what we had expected on that return. This is going to go through OCI. And now remember that the $2,025 is a loss. OCI is a credit balance. It's part of shareholders' equity. So to decrease OCI, it's a loss, so it's bad. It's going to decrease our equity. So we need it to be a debit to decrease it. We're decreasing a credit balance, okay? And then the offset to this remeasurement of plan assets is going to be to decrease the plan asset balance, because we thought the plan assets were going to be worth 143, and now they're worth, if we net those two, they're worth 141,750, which is exactly what the question said. Same thing here. If we look at the offset to pension expense and then what we've put through OCI, we get a net offset of 141,750, which is exactly what we want. Okay, I think we've picked up everything in the question. So we were asked to calculate the post-retirement benefit and do all the required journal entries for the company. Okay, so let's start by running the totals through our pension worksheet. Okay, let's run these across. Okay, so we can see that for the year, we're going to have a debit in our OCI of 2025, pension expense of 222,750, decrease of cash, and the DBO in the pension plan is just almost 2.1 million, and the plan assets are almost 1.7 million. So does the pension plan have a deficit or a surplus at the end of the year? Well, the pension plan has a liability of 2.1 million and assets of 1.7. So clearly it has a shortage or a deficit. And that is what the corporation needs to record in this net asset liability account. So the difference between these two items in the pension plan is what needs to be picked up on the books of the company. So the company started off the year with a deficit in the pension plan of 225,000, and it's ending the year with a deficit in the pension plan of 525,000. So the deficit has increased. Now let's record the journal entries for the corporation for 2020. So the first one they're going to record is pension expense. So we're going to have debit pension expense. Pension expense, which is going to be this number right from our worksheet. And the credit is going to go to this account, the net defined benefit asset or liability account, which is this account here. So this is going to be an offsetting credit of the same amount. And I'll show you how this works in just a minute. Then we're going to have our contributions. So we're going to have debit and credit. So our credit we know is to cash. It's right here in our worksheet. So our credit is going to be this amount. Okay. And our debit is going to be now to this net defined asset or liability account. Net defined benefit asset or liability. Okay, and this is going to be 47,250. Okay, and those are both of our journal entries. Now, let me show you how this reconciles to the same amount that we have here for our net defined asset or liability. So first of all, when we look at our journal entries, a lot of the journal entries in our pension worksheet gave us the right amounts, which is why we used it. It gives us all the right information. But if you look at like our benefits paid entry as an example, actually, let's look at current service cost. Current service cost was an entry between pension expense and the plan. Now, of course, we need all of our books and records to balance just in the corporation itself. We know our balance sheet has to balance, obviously. So when we do these entries, we are balancing through this net defined benefit or obligation. The amount shown on the statement of financial position will absolutely be this 402. But the way that we record these entries is that they offset through this net defined asset and liability. We also need to recognize our OCI amount. So we're going to have debit, remeasurement loss, and we always label an OCI. That's why we have that label there, just so we know what's going through OCI. 2025. Oops. 2025. We lost $1 there. Okay, and then we're going to have credit. net defined benefit, asset, and liability. It's going to be here, 2025. Okay, so let's look at how this reconciles. Okay, so we're going to have, so our net defined benefit, asset, or liability reconciliation. So we're going to have net defined benefit, asset, liability rec. So we're going to have opening. So as an opening, we had 225 negative. Then we had pension expense, which is also a credit, so it's also a negative. Then we had contributions, which was a debit to the net defined, which was a debit here, so that's going to decrease it. Then we had the OCI amount, which is a credit, so it's going to increase it. And then now we're going to have ending balance. Whoops. So you can see that this is the exact amount that we have in our statement of financial position here, 402,525. So this is just illustrating how all these journal entries that we recorded here, where we hit the net defined asset or liability account, which is the balancing account for all of the entries for these amounts, how the fact that we're hitting that as our balancing entry or our balancing account, how it reconciles to the same amount that we knew it was going to be, because it's the difference between what's happening in the plan. And you can show that all of your entries actually reconcile to the right balance. So we already knew the balance was 402, but it's kind of interesting how when we know these numbers, but we didn't know which account was going to be the offsetting account. When we offset to this account, it still gets us back to exactly what we expected, which matches our pension worksheet. So the debit to our pension expense that we knew from here is the offset is to this account, the net defined asset and liability. Contributions, we knew our contributions here were a credit balance of 47,250. The offsetting account is this net defined asset or liability as a debit. OCI, we knew that this was a debit balance of 2025. The offsetting account is this net defined asset or liability account here. Okay, and using all those as our balancing entry gives us the exact same figure that we took, which was simply the difference between the surplus or the deficit in the pension plan. And that's what this reconciliation shows. The question didn't ask for this reconciliation, but I think it's important just to illustrate so that you understand how hitting these accounts still bounces back to exactly what we had picked up on our pension worksheet here. Okay, so we've definitely done one. We've calculated the post-retirement benefit expense, and we prepared all required journal entries. No problem, by the company. Then B says, assuming primary colors follows ASPE, do the same. Okay, so let's take a look. So if primary colors followed ASPE, the only thing that would be different is that we wouldn't have OCI, no OCI in ASPE. So what's going to happen to this remeasurement loss on plan assets? It's still going to be a debit, but now it's going to go through pension expense. And so that increases our pension expense by that difference that went through OCI. And everything else is exactly the same. That's the only difference. It's just remeasurement losses or actuarial gains and losses that would go through OCI versus pension expense. Of course, pension expense under ASPE. So if we look at our journal entries, the only difference that we have is that now our pension expense, and because I linked the formulas, it's already updated it. Now we've got this 224,775 going through our pension expense. Our net defined asset and liability is the same. Of course, this amount goes away. There's no OCI entry. And now our surplus and deficit, of course, is the same, and it still is the same here because all we've done is move what went through OCI into pension expense. So we still bounce back to the same figure. And that is what it would look like under ASPE. And you've got the journal entries updated under ASPE as well. Part 2 says, assume primary colors follows IFRS, calculate a post-retirement benefit worksheet, which we already did do. So we've covered off part 1, A and B, and we've actually covered off part 2 as well through the completion of our pension worksheet.